Okay, it is time. The time has come. I want to take this opportunity to thank everybody for joining us today. I am Noah Rosenblatt. Right next to me is John Walkup. We are both from UrbanDigs. And today, you guys are going to get an amazing education on what is going on right now in the Manhattan New Development marketplace. Grab your pencils, take your notes, prepare your brain. We got some good food for your brain coming up here. And these great speakers are going to take us to the promised land.
Yeah, and thanks, Noah. And I just want to point out that in the registration link, there was a little box for questions, and we got well over 200 questions here. We whittled those down into sort of the core ideas of each one. So if we didn't get to your specific question, we apologize. There were just so many. But with that, I think we should get started.
Yeah, we're going to get started, John. Let's introduce the panel. I got Shlomi Reveni here, right here. He is the president and CEO of Reuveni Real Estate. You all know him. You all know Stephen Kliegerman. He is the president of Brown Harris Stevens Development. And of course, we got Ryan Schleis, who is the senior vice president of research and analytics at Corcoran and Corcoran Sunshine. Really an amazing group here. And we're going to start out with the question that was the most frequent question. Shlomi, I want to start with you. With so much confusion out there, can you please provide an honest assessment as to the current state of the new development market, negotiations, concessions, sales, and if possible, give us a breakdown by different price sectors?
Sure. So first of all, let me just say thank you, Noah and John, for inviting me on this discussion. I love what you guys do. I'm a great fan, and great to be here with Ryan and Stephen, two very amazing professionals and great minds in the industry. And hopefully Stephen and Ryan, we don't agree on everything here. And hopefully we have a discussion and we possibly not see eye to eye on every single item. So yeah, so the $1 million question, right? What are the discounts like? There is a lot of confusion out there. There's not a lot of information on deals that just got made, in other words, contract. So let me preface this a little differently, maybe just a little differently. Not every project is the same, right? And you can't I don't think you can make a blanket statement about the industry in terms of what are the concessions like, what are the discounts like. I think it's different for different submarkets. I think it's very different for different projects. And as an example, the Benson, which is a very successful project by Mickey Naftali on the Upper East Side, I spoke to Mickey. He's made some representations. There has not been any negotiations, right? And I believe that because that is an outlier, I believe, in terms of a product in a specific location and a specific submarket that is very much in demand by very specific demographic that's willing to pay a premium regardless of market conditions. So, but overall with new developments, I think we can also separate between new developments and resales. I think the resale market is different. What I'm seeing in the resale market across the board, again, with exceptions here and there in terms of certain locations and submarkets, is someplace between 12 and 15% from most recent ask. As far as new developments are concerned, I think it's different in terms of what a developer can do in terms of a discount for different price points. In other words, if you look at product that's up to $3 million or $4 million, and you look at other products, even in the same building, that is listed at, let's say, 15 to 25 or $30 million, the negotiability factor between these two might be different. It also depends on the age and the phase of a project. If something has been lingering for the past 5 to 6 years, you can probably expect a higher level of negotiability on a project like that than you would with something that maybe just went to market. Because if something just went to market, the time frame for a developer to actually give concessions and deep discounts he's got a little more time to do that. And maybe during that time, they will see an improvement in the marketplace so they can sit tight. But what I'm seeing across the board right now, and again, with the idea that you have different submarkets with different product, is at the lower price points, I'm seeing negotiability of anywhere between 7 and 12 to 13%. At the higher price points, I'm seeing deeper discounts. So we've all seen transactions and big penthouses and apartments listed about $15 million. I think that for a developer to build a building that's, let's say, a 20-story building the top 20% of the building being penthouses, the price per square foot construction for that building is probably the same on average between the lower floor and the higher floor. That's how we look at it in terms of average. However, your price per square foot and price point on the higher floors, because of a premium of views or outdoor spaces, is much higher. And there may be a little more room in that sector of the building for negotiability. So I've seen a lot of penthouses that have gone into contract in the past few months. I believe that the discount level on some of these penthouses and some of these very premium properties, and some of it has been reported, is probably about 20 to 25%.
And that includes concessions, I assume, right?
That includes all in. So a developer looks at the bottom line, just looks at net. They don't care if it's a price discount or transfer taxes or mansion or common charges, whatever it may be. It's just about the net. What do I net at the end of the day? And if an apartment was listed originally at $5,000 a foot or $5,500 a foot, and below in the building you have apartments that were listed at possibly 24 foot, I think the negotiability level on that unit on top is much higher than something at the bottom of the building.
You know, and in addition, you know, not every building is priced the same, right? You know, some developers get a lot more aggressive and price higher in the beginning because maybe their timeline is different, or their cost of funds is lower, or they're building out of cash, which actually does happen every once in a while. I've got one right now. You know, so there's no standard negotiability. I get that question a lot. And you know, and from our brokers, you know, I'll get a call, you know, what's the negotiability factor? So there is no factor. Every project has its own balance sheet. Every project has its own goals. Every project has different investors who have different levels of you know, experience, and also levels of returns that they want to get. In addition, Brooklyn is vastly different than Manhattan. Queens is vastly different than Brooklyn and Manhattan. So, you know, we see different negotiability factors at different price points, as Shlomi said, but also from project to project. Also, not every project is overpriced to begin with. Some developers actually come out and price the market. So those projects are going to be less negotiable than one that is vastly overpriced. On the to the high end that Shlomi was talking about on those penthouses, you know, we've seen in the headlines the $50 million penthouse that sold for $23 million. No offense, it was never worth 50. It was probably never worth 40. It may not have been worth 35, and it finally sold at a price that it was worth. And frankly, I don't think that penthouse would have sold for much more in a post-COVID world or a pre-COVID world. I think those properties were probably overpriced to begin with. Maybe the buyer got a little bit better deal because of the situation right now, but it was overpriced day one.
Mm-hmm. Ryan,
I want to add a little bit to that, which is I totally agree with everything Shlomi and Steve are saying. And the important thing, yes, there are averages that people use as benchmarks in our portfolio. For example, the average negotiability is 14% for new development, but there's an incredible range in that number, right? There's 1% to 30, 35, 40% in a few odd instances. But so what I think the folks that are listening need to remember is they need to scrutinize why am I getting an above average negotiability? Are my buyer's obsession with huge discounts, is that healthy, right? If I'm getting this big discount, what is causing that? Is it because the building's not selling well, and am I going to be the only person in this building that's bought because nobody else wants to buy here, right? So you need to really think critically. Often, not only is it that the buildings that have lower negotiability were priced more to market, as Steve said, but also they might be selling better, right? So they just don't have to negotiate as much.
Yeah, I mean, at the end of the day, it's again, good market or bad market, it's about supply and demand. And certain sub-markets in the city and certain projects in the city, and we've seen them, and you can call them outliers, if you will, the negotiability level is much lower because there are more people that want to live in that building in that specific location, and duplicating that anywhere else for that demographic, for that specific buyer is not possible. So if they're sticking with New York, if they're going to buy New York, if they raise their family here, if they work here, and they want a specific environment for themselves, and that's all there is, and they can afford it, then the negotiability level is lower. And it's up to a developer and a marketer, their sales team, to understand that, to understand the nuances in terms of specific market conditions, as it applies to their specific project in the submarket.
The moment of peak negotiability has passed also. I think
that's a
everybody
great
needs
point.
to be aware. That was when we were in virtual operations, when the market was shut down, when things were changing. Now, a couple of things have happened, right? The market has started to improve. We're seeing incredible increases in the number of signed contracts over these past few months. And quite frankly, prices have come down a little bit, and especially in new development, more projects have lowered their prices. So we're seeing less negotiability now than we did, for example, in second quarter.
Let me just add something to that. That is probably right for maybe 80% of the projects in the city. I think there are projects in different phases where maybe you're not 60% sold or 70% sold. Maybe you're 30% sold, and you really have to get things into contract. And the peak of negotiation, while the rest of the market might be doing better and is doing better, you may still have to negotiate very strongly in order to get to a certain threshold in terms of sales. So that negotiability factor for that specific project or building may still have to continue in order to get transactions, because buyers are not stupid, and there's a lot of information out there. Nobody wants to be the schmuck that's going to pay too much. Everybody's looking for a deal, and everybody's looking for a strong deal. And if certain projects do not reduce prices with the hope that things are going to get better, they might, but they may not specifically for them. So the balance of getting absorption now and getting some sales now versus taking the risk of kicking the can down the road and maybe getting it later is a dangerous one for some projects.
Well, let me tug on that thread a little bit and ask you for a second, Stephen. Here, we talked about negotiability from sort of an individual unit perspective, but I'm wondering if we could touch on the idea of bulk deals out there, in which investors are coming in and they're buying chunks of units en masse and at levels of which the discount is much more opaque. Do you have any examples or experience with those in recent months?
So I must get no less than 3 to 5 phone calls a day from brokers, both in my firm and other firms, asking about bulk deals. Everyone thinks there's blood in the water. Everybody thinks that every developer is panicking. There have been very, very few bulk transactions that have been completed. There's actually one that is in contract right now. That deal's been around for over 2 years. Shlomi successfully sold a good number of those units before they went bulk. Ryan, I know Ryan's team and my team, and I'm sure Shlomi's team have all evaluated that bulk deal. And literally that was a bulk deal that had nothing to do with COVID. It had everything to do with other factors. And that transaction is now happening. But in general, developers are not really apt and excited about selling bulk. Number one, when you have a large bulk deal in a building, it affects end users' options for financing. So if you have an investor that owns more than 10% of the units in the building, one-off buyers are going to have trouble obtaining financing in that building, okay? Number two, most developers can't drop the price to the level that an investor would need to purchase at in order to have a reasonable return. Right? A reasonable return expecting appreciation in the future is somewhere between 2 and 3%. When you factor in common charges, real estate taxes that unfortunately continue to go up, even in tough economic times, the returns just don't work. So there have been some buildings that have been talked about, the entire building being sold. We know that there's a couple that have come off the market. And those buildings may transact, whether they come back as condos or rentals, we don't know yet. But the bulk deals, buying 10, 20, 30 apartments, it's just not out there. Also, the minimum release prices that most developers are under with their banks and their investors won't allow for those sales. Because remember, the bank and the investor, and then maybe the mezz, all have lower basis than the developer. So why would they want to sell at those low prices when they know that they could work with the developer, hopefully,
Shlomi,
to eventually get those sales completed?
Shlomi, it looks like you're dying to say something here.
Yeah, please jump in, guys.
I'm always dying to say something. So like Steve, and I'm sure Ryan and Corcoran, I get calls on a regular basis for bulk deals. Now, I've evaluated many bulk deals and many projects that may be going to the bank, many opportunities in the past 12 months. I got to tell you, I have not seen one good one. I have not been able to, and I've provided my recommendations for what a project with bulk units should be bought for, carried for the next 2 years as a rental possibly, and then maybe sold later in whole, or maybe you sell a portion of it now at a lower price. And the expectations that capital has for these type of opportunities versus where a developer may be and their partners, like Steven mentioned, just don't match, right? In order to do that in today's environment with rising costs of real estate taxes and carry and cost of money and also absorption, you can't just take 50 units that were condos and decide to rent them and expect to rent them all immediately at a high return. There is no return because your carry in a building today, in most buildings, unless you have a tax abatement, is $36 to $40 a foot, $42 a foot. If you get $70 on average, and that's before vacancy, that's a gross number before vacancy. Imagine not everything is rented immediately. You may have to wait 6 to 12 months to actually rent some units. So that actually takes away from your profits as well. It doesn't pencil out. It doesn't pencil out. And what Steve mentioned, a project that was trying to sell at $2,000 a foot per Schedule A that was written 3 years ago, and you got many of those in the city, right? Many of those at $2,000 a foot that could not sell at $17 a foot in the beginning of 2020, right? What's the expectation for a sellout, a healthy sellout and absorption today, in today's market? It may be 15 to 16. So if somebody buys that, right, as bulk, at what number do they need to be, carry the building, and then sell at a profit without seeing losses? The numbers, again, don't work, at least not in performers that I've evaluated.
Okay. So
we're not there yet.
So we can get that out of the minds. Any agents that are really, really focusing on that, it might be a dead end, or at least consider potentially being a dead end. I mean, you guys all looked into this. The numbers aren't making sense.
Yeah, I mean, the way it could make sense, and it's one that I actually did years ago, is when an investor comes in and actually finds a way to partner with the developer so that they keep the developer in either for some back-end participation, kind of like a hope note, so that at least the developer continues to have some skin in the game. So maybe they're willing to take a little bit less now because they believe that in 2 or 3 years, the market will come back. At 540 West 28th Street, we did that deal years ago for Eric Eckstein, and it actually worked out great for everybody. Eric sold 20 apartments. He stayed in for a back-end participation over a certain price per square foot or return. And at the end of the day, the deal worked out for everybody. Right now, all I'm seeing is investors coming in wanting all or nothing. And that's just a really hard deal to make.
Which makes me wonder, what is bulk? Is it 10? Like what considers bulk? I mean,
well, everyone has a different definition of bulk, but I would say probably, a minimum of 5, probably 10% minimum of the inventory.
Yeah.
Again, but as Shlomi said, then, you end up with a problem with, how quickly can you rent those units? In a good market, maybe you'll rent them quickly. The rental market right now is frankly in much worse shape than the condo market is.
Right.
And Noah, I've seen requests for bulk as little as 3 to 5, 6 units, and
Yeah.
I've seen the capability from certain entities to purchase a whole building.
Right.
And the building that we've been talking about on 43rd Street, that was an $80 million purchase, which is approximately 70 or 80 apartments, right? And an average of $1,100 a foot, and one entity bought everything. So it really varies.
Okay. I want to move on. Ryan, this is for you. Stephen just mentioned the distress in the rental sector. I think there's just as much distress in the commercial sector that's going on right now. Do you see commercial buildings potentially converting to condos in the coming years?
I hope so, but they're not happening just yet. So when we look at all the pipeline buildings that we are tracking, so thousands of units under construction or just planned or even proposed ideas, it's over 13,000 units, only about 5% of those units are office properties being potentially converted to condominiums. And the vast majority of that is actually one property, which is One Wall Street, which has been underway for a long time and is coming to market soon. So the reality is, my pipeline, I'm not seeing anything that has actually been now switched or starting to be considered being switched from office to condo very recently. These are all things that have sort of been in the process for a long time. That's a big difference from the last cycle. So going forward, do I expect that to change? I hope so. I think that there's a real need, and I love the ideas that are kind of being floated around the industry about shifting some obsolete office space into residential, offering residential that is more affordable to a broader base of people, creating more 24/7 environments in neighborhoods like Midtown that could really use it. But I'm just not seeing it yet. It's really tricky to get those deals together, right? You've got to have a building that can lay out well with residential. Most office buildings don't, right? They're too deep or they're too bulky. You have to have a building where you can get all the tenants out in order to do that sort of conversion. So it's going to take some time before these happen, but I do think we will see some, just it's not going to be a huge flood of them.
Yeah, I mean, I think that the whole resi to or the commercial to resi was more of a PR thing than anything else, frankly, for the governor. It's really hard to convert a commercial building to residential. They're usually too deep. Their HVAC systems are completely different. Their mechanical systems as a whole are completely different. You know, there are some mid to small size buildings in the financial district or in the Flatiron district that lend themselves, because they're more loft-like buildings, that would lend themselves to conversions. But, you know, the loss factor in these buildings is tremendous. You'd have to change all of the mechanical systems. You'd have to change all the windows, because you need operable windows in a residential building. And most of these office buildings have either inoperable windows or windows that really don't work well residentially. And frankly, this office situation hopefully is not going to continue forever, and we're going to need Class A and Class B office space again. Right. So, you know, to add more inventory by allowing, you know, Midtown office buildings to convert to residential just seems foolish. I also think there's probably better uses for those buildings than residential.
I agree with all the challenges that these buildings have, obviously physical challenges. However, I do think that, you know, eventually people will come back to the city, obviously, and occupy office buildings, but I don't believe that the office building concept of the future is what it used to be. I think that status quo is out the window. And I think there's definitely going to be need for less space for companies. Now, I do think that this is an amazing opportunity to do something with it. And there's been some suggestions about incorporating and incentivizing developers to come in and do it based on 421A tax abatements and an affordability component, which I think is a great idea. A lot of these buildings are in areas where the zoning does not allow for residential. So you'll have to do zoning changes as well, but that is work with the city, and I'm a big supporter of that, of developers working with the city, getting incentives, and actually putting something to work that can help the city in terms of affordable housing, and I think that this is a great opportunity to do it. So I do hope that this is a direction for these office buildings, because I don't think that the amount of office buildings we have now will. I'm very bullish on the future of New York, of course, and talent and creativity and workers here. But I do think that the concept of office buildings will change, and this is a great opportunity.
Yeah, that's interesting. Shlomi, let me dig into that affordability aspect, and not necessarily in the residential side, but on the development side. You know, there's been a lot of news reports out there that the cost of materials, the cost of building is increasing, and I'm curious, how is this going to affect developers now and going down the road here?
So that's a very good point about future development. Look, I speak to developers and construction managers on a regular basis. The cost of construction is very high. New York City right now is still, I believe, is the most expensive city in the United States to build, which is not good. Right now, we still are more competitive and more affordable in terms of construction costs with major global cities like Tokyo and London, But in New York is the most expensive city in the nation to build. And that is, there's high demand for labor and material. Local union wages are very high. Carpenters, bricklayers, iron workers is very expensive. And raw materials are expensive and have gotten more expensive. When you talk about steel, when you talk about lumber, copper pipe, cement, all of that has gone up recently. Now, China is buying everything. And I believe that that's driving up cost as well. So what is a developer to do? One of the biggest increases when it comes to construction in the city is insurance, right? That's the underlying number there that you don't really see. But I spoke to a developer today that's doing construction right now, that's hiring, buying a job, and he's telling me that insurance has come up 30%. It's very difficult to build in a city. It's very expensive. It's very risky, and insurance carriers are very worried about that, and that's why cost is going up. The problem with this is that financing for construction is very limited because of it, because construction cost is high. So it's limiting construction in the city. Now, the flip side of it is this. If it's going to cost you $500 to build a building in a city, $550 today, right, on a per square foot basis, all in. If it was $575, which is a big difference, when you talk about a building that's 100 square feet or 100,000, 200,000 square feet, that's a lot, right? But is that going to prevent a developer from actually moving forward and building? Is that really going to change, make or break a deal for them? I don't think so. It's expensive, it's difficult, but as long as the financing is there, as long as the capital is there to finance, I think they'll move forward with it. Construction companies are not coming down on price. It's unbelievable, but they would rather go down south and build in Florida or in Texas than reduce prices here. They might shut down their doors, or they may take up affordability work or institutional work instead of doing construction resi. So there's a balance here, but developers are a very special breed. They're here to develop, and in New York, they're going to keep developing. So this is always going to be a struggle, and I think a lot of it has to do with work in the city. I think the city has to step in as well and kind of promote that level of work, which is all about hiring, workforce and possibly building green as well, right? All of that has to be promoted. But it's expensive. It's extremely expensive, but I don't think it's going to stop developers from keep building.
Are permits, I assume they're down. I mean, with this deflationary shock that we had last year, and I mean, let's face it, the market wasn't in a great place before it, right?
I think permits are down year over year. Maybe Ryan can correct me or Steven, but I think it's like 75%.
Right.
Ryan's the number cruncher. I'm going to let him tackle that one.
I don't have that number off the top of my head, but they are absolutely down. But that's a lot of that's actually driven by the rental market because there's so much less multifamily construction happening.
Exactly. And at any one time, 80 to 90% of those permits are rentals anyway. So, right. But I believe that permits are down probably close to 70, 75%.
Okay. So you got high costs. You got a market that is deflationary and down. It's not up, it's down. There's a market problem, so to speak, relative to the last 5 years. I almost feel like we're setting ourselves up for a problem. If we could just not look 6 months ahead for a second and we look 3 years ahead, is there potentially going to be an inventory problem in new development because of all this, the downtime?
Yes, absolutely.
I think there will. And I think if you actually look back a year, January, February of 2020, we were trending in a very positive direction absorption wise, and prices had stabilized. So January, February of 2020, absorption was up, I think, over 40% in those months, okay? Then, of course, COVID hit and everything stopped. But if now you look at the last 4 months, we're back on that same trajectory. And yes, new development, condo new development inventory is not going to be building at the rate that it was building last year or the year before, because, as you said, permits are down. As Shlomi said, financing is more difficult to obtain. Yeah. And developers are also, also looking at the land market, and the land market hasn't quite reset itself to where it needed to be. So I think 3 or 4 years from now, we are going to have an inventory problem. I think there'll always be a little too much inventory at the very high end of the market, because I think we just overbuilt in general, if you look kind of at Billionaires Row, sorry not to bash it, but there's a lot of very expensive apartments for a very small segment of the population that doesn't need to buy. It's a want to buy. But I think if you're looking at the $1 to $5 million marketplace in most areas, and I think on the Upper West Side, the prime Upper West Side, if you're talking about anywhere up to 10 to 15 million, I think we're going to see a tremendous inventory problem in 2 to 3 years.
All right, so let's stay on the
Development.
inventory.
I think Ryan should get on that one.
Ryan, go ahead.
Yeah, definitely.
Yeah, I mean, development is a big ship that's hard to move, right? It's hard to steer. So these things take a lot of time. Now, right, one of the things that people could shift lately is when they launched projects. So there are, and I think we're going to talk about shadow inventory in a minute, but there's a lot of shadow inventory that people are trying to sell. They just aren't have it actively listed. But there's sort of another level of, ghost inventory or whatever we want to call it that would be on the market if the market were better. 4,000 units under construction in Manhattan that have not launched for sales, but if there was a stronger pre-sale market, would have already launched for sales. So there's a big backlog of that inventory, but there's nothing new. What you're kind of getting at with the permit question is there's nothing, very little being new being initiated. So it is going to take a few years to get through and get to that low inventory moment. If we look at the last cycle, right, the peak of inventory was 2009, obviously, and then it took till 2013 before we had a dearth of inventory because nothing was really initiated and then coming onto the market at that time. So I think if we think of this year or maybe even next year as the peak of inventory, it is, I agree with you, now we are going to see, in 2-3 years, a really, really low inventory environment again.
Yeah,
Is that a Manhattan? Is that something for Manhattan, or is that Manhattan and Brooklyn, you think?
I'd say it's Manhattan, Brooklyn, and Queens, frankly. I think all. There are a couple, and I know we're going to talk about other markets. The Queens marketplace is starting to really come into its own, but the majority of that product is still rental.
Mm-hmm.
All right, so I want to go into the shadow inventory. Stephen, let's start with you. I know there's a shadow inventory problem. I'm going to get all of your thoughts on this one, but Stephen, we'll start with you. Since many sponsors don't list the full sales lists, right, shadow inventory, what do you think is the actual inventory right now for development products? And how is that pipeline now versus the last few years?
Right. So as we said, the pipeline is definitely lower now than it has been in years. And I agree with Ryan. There's definitely some projects that have not come to market yet. So we'll consider that shadow. Plus, we'll consider shadow anything that is in an on the market project right now that isn't on the market. It's impossible to come up with an exact number. Total inventory right now in new development, I would say, is somewhere between 5,500 and 6,500 units. Of that, about 80% of it is shadow and 20% of it's on the market. So, but shadow is just unreleased. It's not like no one knows about it. It's a question of when will it come on the market, right? And so what we do is we take a look at Schedule A's and we take a look at each building and we figure out, okay, each building has X number of units on the market and the rest of them are shadow. It's, and if it's 5,500 to 6,500 units, frankly, in the entire city, that's not a lot. That's now what we should be looking at. And Ryan, maybe you have these numbers handy, is, and I've got some, is in what price segments and what price points that shadow inventory is available, right? Because the absorption, and I think there's somebody had a question about it, really has been in the 1 to 3 or 1 to 4 or 5, depending on what area of the city you're looking at. The absorption's really been under $5 million, $4 million, $3 million for the most part. Although we are seeing a lot of new transactions in the 10 million and up marketplace, particularly something like 1045 Madison, which Shlomi spoke about earlier, where they're doing quite well. So shadow is probably somewhere in the 4,000 unit range. But again, that's just that it hasn't been released to the market yet.
Yeah, I agree about the unit mix, and you need to qualify that. Of the numbers that we have, all transactions in the city, about 85 to 90% of all transactions in the city are under $3 million, right? And what you get at the high end, most of the high end transactions, the biggest percentage of transactions are new developments. They're not really in resales, right? So the very high end market is doing well in the past few months, and below $3 million is doing well. if it's about 85 to 90% under 3 million, under 2 million represents about 75% of that. So that market, which is co-op condos and new developments, is doing well. It's the mid-market that worries me. Now, when you have a beachfront property project, right on a park, right on a river, sub-market like the West Village or Mickey Naftali's project, I think you're going to get absorption there all day long. But absorption of these mostly new development projects, what does that represent as a whole in the market? That's maybe 10% of the number of units. It's higher percentage of volume in terms of dollar volume because at least recently, most of the large transactions occurred in new development projects. So they might actually represent about 25 to 30% of the total dollar volume. But it's that mid-market, right? Your pedestrian type buildings, I'm calling them pedestrian, with your cookie cutter unit mix of studios, 1 bedrooms, 2 bedrooms, and small 3-bedroom apartments, that you can find in the financial district, in Chelsea, in the West 50s, in Nomad. That inventory needs to be absorbed. And I think that's a little more difficult. And the problem is because construction costs has been high, because land costs has been high, you have developers that are sitting on projects with that type of inventory that is listed between $2,000 and $2,300 a foot. And where's the absorption there unless there's a fall down, unless there's a default, unless it goes back to the bank? That absorption, to me, it's not the very low and the very high end. I'm not concerned about those. They will sell. It's the mid-market projects and mid-market inventory that's been built, basically strategized, planned, and built pretty much the same in the past few years, right? In terms of 750 square foot 1 beds, 1,000 to 1,150 square foot 2 bedrooms, 1,600, 15 to 1,700 square foot 3-bedroom apartments. That is, you can find that in the city all day long. And I think it will take much longer to absorb that unless there's a reset of pricing.
Interesting.
Yeah, and
Let
again,
me ask you this. I'll
it
just throw this out.
depends
This
on how
one-
they price to begin with, right? So, and I also think you have to look at it year by year. Like if we look at the pipeline for 2022, there's not much in the pipeline for 2022, right? So the inventory that we have now is going to carry us through 21 and 22. 23, there's more inventory supposedly coming. But again, a lot of these projects that are projected, many of them don't even have financing yet. So we don't even know if they're really going to come to market or not because they don't have construction financing yet. Their equities, some of them don't even have all their equity together yet. They own the property and they're hoping to find investors and a lender that'll buy into the project. But a lot of these projects may get kicked down the road further too.
Or they may come in at a lower basis.
Right. And then, the other thing that we have to watch is the sunset of the 421A. Right. So if there's no new 421A, we're talking about rentals now. Then what happens with all these sites that were projected to be rental sites? All of a sudden, they don't work without a tax abatement, but they may not work as a condo either. So developers are going to have to figure that out, and the state's going to have to figure that out. And frankly, the state's going to have to come up with another abatement program if they want to continue to see affordable housing in the city.
That's right. I think local government has a lot to do with this. And look, we were sitting here. I remember during COVID, March to June, nothing was happening. Things were very pessimistic in the city. June, things opened up a little. And then we had demonstrations in the city, which again, kind of, gave us a pause in terms of surreal existence. But July and August were kind of dark. When I look back, when I try to project what the future was going to look like, it did not look good, to me, at least. I did not have a good feeling about what was coming. But then Labor Day came around and things changed dramatically, right? And all of a sudden, you see these people buying apartments. Rates are low. There's more demand. They want to stick with New York. There is just amazing energy out there when it comes to transactions. And it's a real commitment to New York City. So the issue is not there. And the issue is not capital because there's plenty of money on the street. A lot more people made more money last year than they did before, right? And sometimes because of COVID, I don't know. I mean, the Wall Street just did extremely well. So it's not about that. It's not about the commitment to the city. And this is all within the context of COVID. The issue here that I see with moving forward in terms of absorption, in terms of construction, in terms of lifestyle and everything else is local government. It's the mayor. It's who's going to be running this city in the future. It's 421A. It's affordability. it's an energy, right? It's a level of energy that needs to be injected with policies, which just doesn't exist right now. And that to me is the main hindrance of moving forward in a healthy way.
Yeah, I think that's it's an election year, so that local government, I suppose, is a big question mark. We haven't even come to the primaries yet, which is really kind of going to decide a lot of things. But with that in mind, Ryan, let me turn this to you. And when you think about the pipeline that you've mentioned, and when you talk about what Shlomi said, which is sort of the mid-market units are just kind of lingering in some places. Are we starting to see any hint of what the next trend in new development might be in regarding the size and the sort of the layout of these offerings?
I think that we're going to be having to watch super closely how, coming out of this pandemic, people's lifestyles, where they work, when they work, what they are really making their purchase decisions based on, and how permanent those changes become, to see what kind of shifts in unit types we get in the next set of pipeline. For the past few years, we've seen a pretty significant shift towards smaller unit sizes as developers were managing to lower absolute price points, hoping that they might still get a little bit of a higher price per square foot by pushing efficiency on some of these condominium units, to the extent where some of these buildings almost looked like rental unit sizes with the smaller sizes of the apartments. And at this point, there's starting to be a little bit of a backlash to that, right? Because now everybody's looking for more space, right? Because we're spending so much more time at home. So I think there is going to be a little bit of a destabilization moment where some of those things that have pushed into the smaller sizes, not the 750 square foot one bedroom, but smaller than that, the 700, the 650 square foot one bedroom, the 550 square foot one bedroom with a sliding door. Some of that is perhaps going to move a little bit less out of favor. And then the next round of things might start to actually push sizes back a little bit larger to where we saw before. What's interesting is when we look at all of our purchasers, we note, what is the primary driving factor for them? And of course, we all know real estate, location is always the number one factor. Last year, it was the number one factor for the majority of the buyers in our portfolio. And while it still is the number one factor, it's no longer the majority, it's the plurality. It's the highest number, but we're seeing a big increase in people who are making decisions instead based on space or based on value, right? People are much more neighborhood agnostic. So they're much more driving their decision based on the amount of space and the value they can get for that space. So I think in the next generation of pipeline, we're going to see that, plus also greater interest in outdoor space, really influencing future development.
Yeah, we're seeing buyers clamor for outdoor space, clamor for a little bit more space, where they can work from home, or they and their significant other can work from home. We're even seeing buyers convert two-bedroom apartments to one-bedroom apartments, which we never saw before. It was always the other way. We are still seeing price point sensitivity without a doubt. But, outdoor space, number one, has been a big driving factor. If there's like a home office area or a nook, or, that's been a big driving factor. We see more buyers looking for views now. I think that they're really thinking about the environment that they live and work in, and they want to have something nice to look out to. So views have been pushing both price and demand a lot. We're seeing buyers actually go back to the more highly amenitized building again, even though they can't all use those amenities during COVID. They see the value in those amenities being in the building, I think more so than before, where buyers were looking at their overall cost of carry and kind of shying away from more amenities. I'm seeing buyers look for more amenities again. I'm also seeing, as Ryan said, like neighborhoods aren't as important, and actually like what we consider to be like the fringe neighborhoods, like by a bridge or a tunnel now, are more important because people are trying to get out of the city, to their summer home or their parents' home or their friend's place up in the Berkshires or something. So those kind of river to river locations are becoming more in vogue than they were a couple of years ago, where everyone wanted to be in a more considered prime neighborhood. I think every neighborhood in the city now is prime. And we're seeing a lot of people take advantage of upgrading now, right? So, let's say, for instance, that the market is off 10% from pre-COVID. If you're selling a $2 million apartment at a 10% discount, but buying a $4 million apartment at a 10% discount, you just made $200,000.
And
right?
chances
So
are that $4 million is probably a little more than 10%.
and it might be a little bit more than 10%. Exactly. So we're seeing a lot of upgraders now. We're seeing a tremendous amount of parents buying for their adult children or with their adult children. Again, investing in real estate. We're on an island in Manhattan, and even the boroughs, okay, are still constrained. Real estate is still a commodity, and it's not growing. So over time, it will go up. I agree completely with Shlomi and Ryan. The biggest challenge we have in our marketplace right now is our city and state government.
It's policies. Yeah.
It's
All right. So we got a
policies.
couple more questions I want to discuss, and then we got to get to a lightning round. We got a bunch of questions still to go through. We're running out of time. Shlomi, I want to ask you about construction loan defaults. I know we mentioned previously it's not really happening, but is this going to become a thing, or are these troubled projects going to be rescued?
I don't know what rescued mean, but it all depends on how capitalized a developer is, how well capitalized they are. And this is not just for condos. This is also for rentals. You have some portfolios out there, rental portfolios with 30% vacancy, 35% vacancy. How do you sustain this as a landlord, and for how long, right? If you capitalize well, you could probably carry it. If you're not, you have a problem, a big problem, and at some point, you're gonna have a conversation with the bank, and there may not be an out of this. Now with development, it's the same. We have not seen a lot of defaults yet, but we've definitely seen some that possibly will be just the tip of the iceberg. And we've all read the news, we've all seen the articles about certain projects that are going back to the bank. I can tell you right now that I'm dealing with at least two projects that we're getting, which are defaulting. One of them is a hotel, actually, a hotel. This is another sector of the market which we haven't covered, but there's a financial meltdown in the hotel industry. And what do you do with all
you're in
these
buying
hotels?
mode right now?
Sorry?
You're in buying mode right now?
You're in buying mode?
Yeah.
Or your clients.
I have clients who are buying these opportunities. So for example, one of them is a hotel, cannot function any longer as a hotel, went back to the bank, bank had to sell it at a discount, and a developer is going to reposition it. I think we're going to see a lot of that with hotels. I think we're going to see a lot of this with we will see some of this with commercial buildings as well. And we will see projects that can no longer sustain and banks taking over. Now, it's not easy for a bank to just take over a project. Not all banks know how to service real estate. A sponsor sometimes needs to stay in the deal and come to a different arrangement with the bank. And I think a bank would rather do that than default, right? And then go to the next level. So how many defaults we're going to see, I don't know, but there's definitely a lot more in the background that's happening right now than is being, talked about publicly. And until that happens, we're not going to read about it. But there's definitely stuff there that's happening right now. The question I have is this: what happens if a project like this goes to a bank, and the bank lets it go for someone else, or puts it on the market themselves at 50 cents on a dollar? What happens to value within that building? What happens to value within that submarket? How does that affect pricing, within that submarket? And if it happens, not just with one or two, but if you see 10, 15 of these projects going back to a bank or an investor buying them to make a profit on them at a lower price, how does that affect the market in terms of inventory? That's a question we need to contend with, because you do have other pipeline projects that are based at a much higher basis, right? How are they to compete? Some of them are better. Some of them can offer more amenities or better views or whatever it may be. But at the end of the day, comps are comps, and that's how buyers look at it. That's how brokers look at it, and that's how banks look at it.
Yeah, and I think it's going to be really tricky, because if you have any kind of price cut at that level, you're no longer competing against new developments. You're also now you're directly competing against the resale market as well. And I think that's one of the outstanding questions that a lot of people had is, if there is this dramatic backlog of inventory, how is it going to affect just the resale condo co-op environment in general? And it really, like you're saying, it's sort of it's not quite understood just yet.
I don't think the dust has settled yet. I think we're still working through this. And I know Steve gets calls like this on a regular basis to analyze deals, and he's going through the same calculations. We all are. This is just the market that we're in, but the dust has not settled yet. You know, the resi market in the past few months is doing well. We can say it's doing well comparison to, you know, the past 12 months. But all around us, the commercial market, commercial real estate market is going through a financial meltdown. You know, it's the hotels, it's retail, it's multifamily, it's commercial buildings. You know, there's just a lot happening on that end, which, you know, would at some point somehow affect the resi business as well.
Yeah, and you know, we've walked some of these projects that, you know, are having financial issues that have been noted in the press. You know, unfortunately, some of these buildings were just really poorly conceived. And the numbers that they were projecting were never really realistic. And if you look at the floor plans, if you look at the layouts, if you look at the views and how the views are going to be obscured in some instances from other buildings, and, you know, unfortunately, no one realized that when they planned the building, you know, all these buildings they'll find their level. I don't think it really has a huge impact on the resale market, because the new development market is typically between 20 and 25% higher than the resale market anyway. And the resale market is still mostly a co-op driven market, not a condo driven market. I think those markets are very, very different. I think the buyer for new construction is a different buyer for the most part than resale. I mean, Shlomi, I don't know about you, but we rarely see a buyer come to us and say they ended up buying in a resale instead of new development. They may not buy in our development, they may buy in another one, but they're usually buying something new because they want the latest and greatest. They want the best design. They want the newest systems. They want something that no one else has lived in, and they want a state-of-the-art building. And unfortunately, you don't get that in resale.
I think it depends on the submarket. I agree in large that most people prefer to be in a new development, but let's do the math for a second. If you have the new developments of the past few years that have built based on a certain design that Ryan just described in terms of square footages, have more efficient units. So if you have an apartment that's a 2-bedroom, that's 1,000 square feet in a new development project, that, yeah, it's nice, it's new and all of that. But if you can, and that's a 2,000 a foot, right, at $2 million, and you can get a resale in the same submarket in a building that has many more amenities and is 13 to 14 square feet at 14 a foot or 15 a foot. So now you have to deal with PTAC units, and you have to deal with older windows, and you have to deal with a lower ceiling. But the disparity here in terms of price per square foot would buy you and possibly your family a better apartment. And what we said earlier was that people want larger. Instead of 700 square foot apartment, 1 bedrooms, they want 900 square feet. Instead of 1,000, they want 13. Instead of 1,500 square foot 3-bedroom apartments, which we have many of, right, 1,600 square foot, they want to be at a 2,000 square foot apartment. The difference between price per square foot and a new development, which is usually right now 18 to 2,000 a foot and not very high-end markets, right, submarkets that are more common, versus a resale that was maybe built in the late 80s or early 90s, where you can get an apartment at 13 a foot someplace in many places, you know, where your common charges are lower, where your taxes are lower, and where your amenities are vast. You can get a pool, you can get great health clubs, you know. So I am seeing actually a huge disparity between new developments and resales. And I do see in certain submarkets, certain buyers more gravitated towards the value aspect of a larger apartment.
That's
This
great.
is why.
Yeah, I was gonna say that's a great ending point for sort of the main question period. Now we can move on to the lightning round, and it's a great segue, because Stephen, the first question is, how are developers going to handle their high levels of inventory?
Again, every developer is different. Every capital stack is different. I think developers are, you know, for the most part, smart business people. They find the numbers that work for them. Most of them have reasonably inexpensive debt, and I think most developers are already planning what their exit strategy is. I think they know what numbers they need to hit, and I think most developers are well capitalized enough to be able to, you know, withstand a 2 to 3 year sellout, which is basically what we would have projected anyway.
Okay, that's good. 30 seconds or less. Ryan, is new development still favorable for investors, or are opportunities drying up?
Rarely. I mean, honestly, with where common charges and real estate taxes are in combination with where the rental market has gone down to, it's really tough for investors right now unless they have a much longer term horizon outlook.
All right, Shlomi, moving on to you. Deal breakers and deal makers. Can you discuss the top 3 things the pros need to know to get a new dev deal done these days?
30 seconds is not enough, but I'll try. First of all, as a broker, be smart. Know how to manage expectations as far as your buyer is concerned. Don't call me after showing an apartment and just give me an offer. Call me first and talk to me. Talk to me about what the expectations are. Tell me, just so we can manage the process to get to a deal. Otherwise, you're not being a good broker. That's number one. Number two, understand the special risks of a building. Understand lot line windows. Understand post-construction, pre-construction, and first year of operation costs. Because if you don't, and it gets to the attorney, at that point when an offer is accepted, it will be too late and the deal will fall through. Third, understand your buyer if they're looking for financing, because financial institutions today are very difficult to deal with, and they change their guidelines on a regular basis with new developments in terms of thresholds, in terms of approvals and all of that. So if you don't have a good institution financing your buyer and you're going to a deal like this, it will be too late later when they tell them no. So understand the financing of projects and just be a smart broker. I find that a lot of deals fall through, unfortunately, because of brokers. They don't do their homework, they don't manage the process, and they just don't know how to manage clients as well.
Make that phone call.
Also, let the on-site sales team do their job. They are hired and paid to sell that project. They know it better than anyone. And today, they're going to help lead you to the right number. Listen to them. Make them your partner. Do not make them your adversary.
That's great. Stephen, I'm going to stay right with you. What are the most valued amenities that buyers are looking and paying up for today?
Well, again, as I said earlier, I think outdoor space, whether it be private or public outdoor space, is very, very important right now. We're seeing a huge demand for pools right now, more so than I've seen in the last 10 years. We're seeing a huge demand for parking right now. Again, I think because a lot of people are thinking about having a secondary home or their parents' or cousins' secondary home. Those are all big. And then, you know, the WeWork type of spaces and the Zoom rooms for people who need to work from home and need to get out of their apartment. We're converting a lot of our private amenity space to multiple Zoom room space to accommodate people working from home.
All right, Ryan, the next one is for you. We talked about it briefly before, but I'm curious, will we see a sunrise in 421A?
Never say never, but I think that sun has set, and at least for condos, is not going to come back.
Okay, short and sweet. Shlomi, design credit concessions. Is there a new law prohibiting this?
If there is a new law, I don't know of it. I spoke to a lawyer who's very close to the AG's office yesterday and understands taxes and state guidelines. The rule of thumb that he says he uses in terms of credits is like 3 to 4%. And whatever credit you give, you need to justify. There's got to be a reason for it. There's got to be in writing, formally stated. But I don't know of a law that prohibits giving credits.
Great.
All right, Stephen, up to you again. Any appraisal concerns for recently signed or any closings recently?
So far, we haven't had any appraisal issues. You know, I know that everyone's always concerned in a changing marketplace, but I think we have enough data within our own buildings, frankly, to justify our pricing. And, you know, I think the appraisers so far have been realistic, but I will also tell you that we're seeing the majority of our buyers put down at least 25% cash. So you usually don't have appraisal issues when you have more than 20% going down. I don't know if Ryan or Shlomi have seen appraisal issues. I have not.
Okay.
Occasionally, but usually it's appraisers using bad comps, and we have to get them the right comps.
Yeah, we prepare an entire appraisal package for the appraisers so they have the right information, because often they're getting it from a bad source.
That's good to know. Ryan, how has marketing new developments changed during the pandemic, and where do you see this move going throughout 2021?
Well, of course, virtual, right, is the name of the game during the pandemic, and I think that's exciting and great and something that we'll see sticking with us for a long time. You know, we have so many buyers who are international, of course, fewer now than in the past, but as that market comes back, having all these virtual tools will be incredibly helpful. But even for the local buyers, many of them enjoy getting that virtual preview before they come in to make sure that this is really a building that they're most interested in. So I would say that is, of course, the biggest marketing change. And then next, I would say it's value. There's so much promotion now that is much more overt about the value that a building offers relative to its peers. And I think that for a while, people didn't want to emphasize that their pricing might be in the value category. It was all luxury, luxury, luxury. And now I think value is so much more important to people that has shifted how we market our properties.
Right. Shlomi, to you, have you seen any sort of out of the way sort of interesting perks / concessions that developers are handing out to buyers to get deals done?
Buy an apartment in my building and I'll buy you a Cadillac. How's that?
Make it a Tesla and you got
we used to do this back in the 80s, believe it or not. We used to give brokers bonuses of the ones who made the most deals. We used to, I'm talking about 1986, 87 now. But so I haven't seen that this time around. But, we talked about design credits. A developer may throw in a closet, custom closets or, shades or stuff like that. But mostly it's monetary. Mostly it's money, right? It's a discount. It's a concession. It's paying for common charges for the next 1-2 years. There was, Extel offered 10 years at some point of common charges and taxes. And that sort of opened up the floodgates, right, for demands and requests by buyers and brokers in different projects. I have seen some of that done, like for a year, for 2 years. I've seen a little more than that, but that's really the extent of it. At the end of the day, just like it's the net for a developer, I think it's also the net for a buyer, right? What do I get at the end of the day? How much am I out of pocket at the closing? So no Cadillacs yet.
Yeah, money is a great incentive. All right, we got our final question. Last question for all, really quick. Which way are prices going? This was, of course, the most frequented question amongst everyone. Will new development price trends continue to decline in 2021? Ryan, let's start with you.
Oh, do I have to go first?
Yes, you do.
I think when you look at the statistics, you will continue to see the price statistics showing lower numbers. And that's because of all the things we mentioned. There's going to be some of these buildings worked out with lower prices that are going to trade. There's going to be buildings that have been kind of stuck, not moving, that'll start trading at lower numbers. So there will be more deal activity at lower price points, driving the average and median price statistics lower. But not all projects are created equal, and I do not think we're going to see a uniform further decrease amongst all developments. Some will because they've held off and haven't done it yet, and others have already done it, and they are going to stay the course with their pricing holding steady.
Stephen.
I agree with Ryan. I don't think every project is considered equal. I think that because of the lower price points, your averages and your market reports will show some lower averages and median pricing. But I think that in general, I think actually the pricing has stabilized, and I think we're just seeing normal negotiations now. That doesn't mean that there are some projects out there that aren't still overpriced, but I think the majority of projects right now are just negotiating within a range of between 5 and 10%, depending on which project it is. But I don't think you're going to see wholesale price changes. I think you're going to see negotiations.
Shlomi.
I think there's going to be continued negotiations for the foreseeable future. I think, like Ryan and Steven said, there will be some projects that do not negotiate as strongly, but I think the majority of new developments will be negotiating. And I think as COVID vaccine kicks in, and hopefully if local government changes in a more positive way towards development with all the incentives that we need and consciousness for affordable housing and all of that, moving into 2022, 2023, while we go through absorption of current pipeline and inventory, I do see at some point, just like in 2011 and 2012, stabilization and then prices going up again. Yes.
Johnny, what do you think?
Oh, put me on the spot. No, I tend to agree with Shlomi. I think we're going to tread water for a while. We have a lot of inventory to kind of work through. We have a lot of political uncertainty to work through. There's macroeconomic uncertainty to work through. We got to figure out the whole commercial situation on both the retail side, the office side. As we mentioned, hotels are in trouble. So there's a lot of overarching issues. And frankly, even if we do decline here, I don't see it to be that big. But still, I think the New York that we're seeing now, the price and the action we're seeing now has been remarkable. To think we'd be in this spot where we are now, if you look back in April or May of 2020, is astounding. So I think the worst is definitely behind us at this point.
Yeah, and I'm going to go to a limb and say I think the bottom's already in. I mean, I think the sales data is lagging. The closed sales that's going to come in from this point forward is not going to represent the market today as it is right now. Putting a bid in, it's going to represent the market 4-6+ months prior. Which, when I look back, I agree with Ryan. I think the discount window, the fear levels, I think that is gone. I think it's a different marketplace. When I look ahead, I think the suburban housing market that's doing crazy things might have issues. I think the urban markets that didn't will actually see a reversal trade and it might come back. When I look at our market, I think that there's tentacles to our market that are still coming online. We are not at full capacity. And when I look at inflation and all the stuff that's happening on the Fed and a fiscal side, and I look down the road, I think we're going to have an inflationary wave that's going to be very, very, very similar to what happened in 2011, 12, 13, 14, as Shlomi was talking out. Yeah. So unbelievable times. I thought this was amazing. I hope that you guys thought this was amazing. I want to take a moment and I want to thank Shlomi Reveni, CEO of Reuveni Real Estate. I want to thank Stephen Kliegerman, President of Brown Harris Stevens Development Marketing, and of course, Ryan Schleis, Senior Vice President of Research and Analytics at Corcoran and Corcoran Sunshine. You guys were unbelievable. You helped all these agents out there. They should be very thankful to have this information. It helps them close deals. It makes everyone happy. Thank you to John Walkup. I am Noah Rosenblatt. We're both from UrbanDigs, and I hope you had a great time, and we'll catch you next time.
Thank you, guys. Thank you very much.
Thanks, guys.
Thanks, guys. Have a good one. Bye-bye.